Hey guys, we're here with Barry Ritholtz. We're going to talk about his post was called "A Dozen Contrarian Thoughts About Inflation," but I want to frame this as 12 things everyone got wrong about inflation. And you did this post July 13th, but you referenced a lot of the stuff that you've been writing over the past, let's call it year and a half. What's the overarching idea right now about a consumer price index that's up 3% year over year, which is what we saw last week, and the current environment?
So I don't want to get too wonky, but since you referenced CPI, you got to start with, hey, it's a model and all models are wrong, but some are useful. And with the case of CPI, not only is it a little wrong, it's a lot wrong because the way it calculates rental housing costs, and then it's on a giant lag, and it's telling you, hey, here's what happened a couple of months ago. For the Fed to rely on, it means they're missing inflation when it's on the upswing, inflation when it peaks and reverses, and inflation when it comes down.
Right. Well, we don't have any data about the future, so we have to
So be
rely on.
patient. Be patient. It's coming.
All right, let's go through these one by one. The
Sure.
first is inflation peaked in June of 2022. I think that's obvious to everyone right now. Maybe not as obvious as it was happening, although you actually and a few other people, but you actually said June 29th of 2022, hey, this is probably pretty much it. Tell us what you were looking at then and why it was obvious to you that we were living through the actual peak at that time.
Sure. Well, in 21, I did a post. Here's what's driving inflation. I named 15 or 16 things. And a lot of those things had started to improve by the middle of 22 and prices had come down. So when you look at the surge in used automobile prices or lumber or copper or certain types of food and certainly energy, it was pretty clear that they had peaked and were falling. The lag in services, first goods went up when during the pandemic everybody shifted from services to goods because we were locked down. When we reopened, hey, everyone went crazy and went back to services. Not a surprise, services took a little while to fall off the peak than goods. But wherever you looked, energy, Rolexes, cars, lumber, everything was falling, and some stuff like wood was back to pre-pandemic
You
levels.
had blow off tops and a lot of those things, and they
Yep.
even in real time you could see that they might not immediately drop in price, but the rate of acceleration was not going to be sustainable. Like
Right.
just thinking out loud, remembering the chart of lumber and saying, "You guys know this stuff literally grows on trees, right?"
That's why every commodity trader knows the cure for high prices is high
Right.
prices. And unlike semiconductors, it doesn't take 18 months to go out and cut down a tree.
Right. All right. Let's talk about long and variable lags. So you mentioned in your recent post in the 1970s when inflation was persistent and home mortgages were double digit, it was fair to assume it may have taken as long as 18 months for FOMC policy to be felt. And you think 18 months these days sounds a little bit long. We probably shouldn't be experiencing a year and a half lag in the modern economy. Can you say more?
Sure. Well, think about it. When the first of all, back in the day, the Fed didn't even announce they were changing rates. There was no policy
Right.
statement. There was none of that. You would see it in the bond market, and so that would eventually translate into the credit market, the mortgage market. So it would take a long time. The 1970s was a million years ago. Modern economy, everything is transparent. Every information moves instantly. Plus, when the Fed is at zero and mortgages are, what is it? 61% of people with outstanding mortgages have rates below 4%. That's a big shift. And when rates go up, it's felt pretty quickly, at least in the portion of inflation that is rate sensitive. The fiscal stimulus, some of the supply chain things, shortages of houses and labor, rates are irrelevant to that.
Right. Transitory. So you say transitory wasn't wrong. It just took longer than expected. So by that metric, everything is transitory. But this is you. A once in a century pandemic with an unprecedented global lockdown simply took much longer to unwind than expected. There was literally no modern analog or comparison. Everyone was forced to make a guess. That said, 27 months instead of 12 to 18 is less of a miss than many have made it out to be. So the Fed was sort of right saying transitory, but maybe they should have said it's transitory so long as we hike interest rates by 500 basis points.
I don't even think it's that. When you break down what was driving inflation, it wasn't necessarily zero. Remember, we were at ZIRP and QE for almost all of the 2010s. What was driving inflation was a large part a giant fiscal stimulus, $5, $6, $7 trillion, still unwinding with the Semiconductor Act, the Infrastructure Bill, the Inflation Reduction Act. We're still going to have more fiscal stimulus, just nothing like we saw during the CARES Act 1, 2, and 3. And, when supply chains get snarled, when you don't have enough bodies at the port in Long Beach, when Chinese shipping containers are just backed up for miles and miles. We all saw those photos in 21 and early 22. It's a process to deal with that. And I think we thought it would take a few weeks to resolve. It took, 5 or 6 quarters, not 5 or 6 months. And so that's why, 2 years later, hey, you want something, you still can't get everything you want on a timely basis, but you can get most of it. That was a key driver of high prices.
Yeah, but like the camp transitory, the people that were in the boat for transitory, they can't retroactively come back and take their W. Like Krugman,
I gave it to him.
Krugman can't do that. Like,
so here's the thing, and I've talked about this from the perspective of people who are investing and just don't have the patience to let their money compound for them. There is no past, there is no future. There's only the right now. The past has the rosy tinge of nostalgia. It has a warm glow with a lot of misperceived memories. Right. The future is just lots of expectations and wishful thinking. The reality is here and now. And when people said this is going to be transitory, very few people are going to say transitory 2.5 years because it's just not how humans operate in the real world.
Okay. Gotcha. All right. Inflation models are inaccurate. So we all get that. And to some extent, they have to be. But tell us what you think this did for all of the predictions and forecasts, and maybe why this time was different than other times that we've had in the past trying to figure out when inflation would abate.
Sure. So inflation models are inaccurate because all models are inaccurate. They're a computer depiction of reality. And so the best they can hope for is something that kind of resembles reality, but they're not perfect, not just because they're on a lag, but perfect example, it's very hard to figure out how the cost of rental apartments are going up. And so the BLS in their CPI data came up with this thing called owner's equivalent rent. This finds its way into a few bullet points because it's 40%. It's the single biggest chunk of inflation. It's the largest component of the services side, and it's over a third of the total CPI. Perversely, during the financial crisis in the 2000s, when there were a lot of available houses and credit was cheap, owner's equivalent rent made housing look like it wasn't in a bubble because all these people were buying houses and they had moved from the rental apartment market into houses. So rental prices went down. Look, housing is deflationary when it was in the midst of a historical mortgage bubble. Today, you have high rates, no houses, like very little supply around. And so owner's equivalent rent somehow, because you're taking people who would otherwise be home buyers and forcing them into the apartment rental market, all that extra demand is sending that up. The Fed perversely is causing CPI to go up.
Inflation expectation surveys. You've been ranting about this for a long. You don't like surveys at all. We know this.
Let me ask you a question because you've done this. I have to ask this to you.
Yeah, go ahead.
Your whole career, you've been dealing with investors, traders, speculators. When you say to somebody, hey, what's your risk tolerance? How aggressive or how conservative are they? What is the single most driving factor in that?
However, the stock market behaved in the last 5 days.
And so when you ask a bunch of random people by phone, where is inflation going to be in 5 years, LOL? What are they going to tell you? Whatever happened the past couple of months, they'll extrapolate 5 years out. And while we were just talking about transitory, people can't conceptualize 2.5 years. 5 years is forever off in the distance. It's like,
Yeah.
wait, you're asking somebody on the street, Joe Sixpack, where's inflation going to be 5 years? You might as well ask them which planet will be the first alien civilization to
All
reach
right,
us.
so why do we ask that question of people, and where does that data actually wind up? Does anyone actually use it for anything seriously, or is it just like something they use to write Wall Street Journal articles about?
So the data comes from the Fed's own survey. They have, the Fed has a giant research staff. And if you listen to some of the Jerome Powell pressers and some of the speeches he and other FOMC governors have given, they claim they rely on this. They say this gives us some insight into what's happening. We talked before about how persistent inflation was in the 1970s. And so when you have about a decade of rapidly rising prices and people tell you they think inflation is going to stick around, they're not just giving you what happened the past 3 months, they're giving you years of recent experience. And so there's a little more resonance to that trend. The big problem we run into is so many of the senior economists today, they came of age in the 70s. Jerome Powell is 10 years older than me. He's 70, going to be 71. His formative years were the worst inflationary years. So he's got a little CPI PTSD from the era of disco and polyester, and he needs to get modern.
Okay. I wanted to ask you about the Fed driving home prices higher. I know you had mentioned this just now. This is a function of what exactly? Like I understand there's a supply issue, and when you raise the price of money, you're obviously not doing a good job at providing liquidity for home builders to build more. But then there's a disagreement about whether or not they would either way. So, like, what is the Fed doing that is actually working counterproductively from what they're trying to do in the housing market?
So first, we have a shortage of homes as a builder reaction to the financial crisis in the 2000s. We really ramped up construction from the 90s to the peak around 05, 06. Remember, housing rolled over long before the stock market did, little unusual. And so for the next decade, builders underbuilt homes as more households were formed, meaning people got married or moved in together. As the population went from 295 million in the late 1990s to today, we're 332 or so million. So you got 30 more million people. We've underbuilt homes. So that's the first thing. The second issue was during the pandemic, if you remember, the people who were living in apartments in cities and couldn't take advantage of it, high density elevators, lobbies, it was not a good place to be. If they could afford it, they went out and bought a second home without a corresponding sell. There's usually that chain of the starter home buys something from the next person, who buys the move-up.
Multi-household families.
So that whole thing froze.
Let's
and
get
then
a place
last,
in the mountains. Let's get a place in the
Right.
suburbs. Let's get a place in the Hamptons, Florida.
So the pandemic
Right.
people just bought up. And then last, normally, if someone wants, hey, a kid's on the way, something is going on, I got a bonus, a raise, let's move on up. 61% of outstanding mortgages have an interest rate of 4% or less. The most recent quote I read is 7.5% for a mortgage. So if you go from a house that's $500 to $650, that's not very expensive. That doesn't change your monthly nut. But if you go from $375 to 7.5% on your mortgage, that's a giant increase in monthly payment, even if your house cost is the same. So people are frozen in place with these golden handcuffs of low mortgage, and that's why in many, many areas, home supplies are at the lowest they've ever been in history in the post-war era. It's crazy. The amount of homes that are for sale, that's why there's not a lot of choice. Prices are elevated, and so many people are being forced into the rental market.
Okay, number 8, you say the Fed is driving owner's equivalent rent higher, which I think ties into that. You said, given the shortage of housing, the rapid increase in rates has perversely caused more, not less inflation, at least in the OER. And you have not been a fan of owner's equivalent rent for a long time. But how What is that? How is that distorting CPI? I guess is the question asking.
It's the biggest portion of CPI. You're basically preventing people from putting their houses on the market because the mortgages are so high. Hey, if the mortgages were 5.75%, 5.5%, even 6%, I think people who want to move would finally come out and move. But when you look at people frozen in place, plus on top of that, not only is higher mortgages making it more expensive to build homes, but you have caused the Fed has caused a huge swath of people who otherwise would be home buyers, whether they're first-time home buyers or retirement home buyers or whatever it is, to go into rental units. And that excess rental demand is a big part of the reason why, yes, it's more expensive to own a home today relative to renting than it's ever been, but it's also more expensive to rent a home or an apartment today than it's ever been. And that's really problematic. You want lower inflation, Jerome Powell? Drop rates 50 basis points. Inflation will actually come down.
So that's your next point. For lower inflation, lower rates. This sounds obviously very counterintuitive, although it shouldn't, because we just spent the entire post-financial crisis with near 0% rates here, negative rates overseas,
right?
No inflation to speak of, disinflation in a lot of cases. So why is this so hard for us to wrap our heads around? And what were you trying to say in the piece about this?
So the government response to the financial crisis was primarily monetary. We're going to take rates to zero. We're going to set up all these credit facilities, all these liquidity facilities. We're going to purchase bonds. We're going to do everything we can to get rates down to zero. Yeah, here's a little fiscal stimulus. We'll extend unemployment a bit.
We'll do a little tarp.
Right, but it was some rounding error. It was nothing.
Yeah.
Fast forward to 2020. President Trump passes the CARES Act 1, 10% of GDP, biggest fiscal stimulus in history, $2 trillion. CARES Act 2, also under Trump, about $900 billion, just under $1 trillion. In comes Joe Biden. CARES Act 3, another $900 billion. So what are we up to? About $4 trillion? And then everything else that's over the next 10 years, infrastructure, semiconductors, inflation reduction, these are all massive fiscal stimulus. So we went from a 90-10 monetary to fiscal stimulus to the pandemic response, pretty much the other way around, 90% fiscal, and the continued persistence of the previous decade's monetary policy. The rates, half a point one way or another, are not going to cause more inflation. Listen, the problem with houses are there ain't enough of them, whether they're built or on existing homes coming on the market. You want more homes on the market, give people a credit or give people lower mortgage rates, and you'll basically get there. Right now, that's the problem. Once you bring rates to a place, and by the way, we had how long, you mentioned how long were rates at zero, and we had an upside 2% target and no inflation?
Well, at zero or close to zero, let's say from 2008 until 2021, the end of 2021.
Remember all the hyperinflationistas, everybody talking about this is going to cause collapse of the dollar, inflation is going to go through the roof. As it turned out, we've had a deflationary economy for most of the past 30 or 40 years. Automation, technology, improved productivity, globalization, go down all the lists. And even 0% interest rate didn't cause inflation post-financial crisis. But $5 or $6 trillion later of fiscal stimulus, guess what? That's the key driver of inflation. The monetary policy becomes almost secondary to that and the unwind of the pandemic. Let's go a
little deeper on that. So number 10, consumers and companies were inflation drivers. And you said, yes, consumers suffer from inflation, but when they willingly pay up for goods and services, regardless of price increases, they cause inflation also. And then I think what you're getting at here is companies basically took advantage of the chaos and they got away with a lot of higher price push-throughs that maybe they wouldn't have ordinarily attempted. So they took their cue from the consumer's willingness to just pay up, and they said, oh, here's what a burrito costs now. This is a new hotel room rate that we're introducing. And they got away with it for the most part.
When I did that piece, causes of inflation 1 to 15, I think it was back in 21, I had greedflation at like number 14 or 15. I thought it was wildly exaggerated. And then over the subsequent year, lots of research and lots of studies came out and said, hey, look at corporate margins. They're doing great, even though sales, my friend Sam Rines calls it margin over or price over volume. They'll sell a little less, but if they're charging a lot more and they're making more margin, they don't care. So I've slowly altered my tune on greedflation. I think it's become
Can you
more
define greedflation for everyone?
even when you don't have higher input costs, but you identify a willingness of consumers to pay up, companies that charge higher rates, higher costs, higher rates, than they need to, because that's their job, to maximize profit.
The need part seems like a slippery slope.
Yeah, no, it definitely is. And on the consumer side, my favorite example is someone says, oh, I'm stuck in rush hour traffic. Hey, you're driving to me in New York or LA at 5 o'clock. You're not stuck in rush hour traffic. You are rush hour traffic. And that's this thing from behavioral finance where we all think of ourselves as outside of what's going on.
Yeah.
We're special. Everybody's unique. Well, I'm not part of the crowd. Yeah, you are. If everybody who paid up for everything from houses to used cars to lumber, we're drivers of inflation.
I want to throw this out to you. Number 11, you say lose the 2% inflation target. I think Abby Joseph Cohen said something similar in Barron's this weekend.
She's stealing my shit constantly. I got to get have Hamburger send out a letter putting them on notice.
So, look. I don't know. Far be it from me to say what the right target is, but I've asked many smart people why 2%, and literally the answer that I get, and they usually wink or smile when they say it, is. Well, 1% is too low, 3% is too high.
Right. Split the difference.
That's where the 2% target comes from. Honestly, I don't think there's necessarily a rigorous answer. It just became the Fed's mantra, and so we all are anchored to it. Well, and maybe it's
welcome
right,
to the world of economics. All this stuff is.
Why should they throw 2% out?
So when you're coming out of the financial crisis, as Reinhart and Rogoff warned in advance of the post-financial crisis era, you should expect subpar GDP, no wage gains, weak job creation, poor consumer spending. And that's what we saw for about 7 years after 08. It took to 15 for things to really start to not quite normalize, because you just did a lot of damage economically by all the headaches that was caused in the credit market.
You had a balance sheet recession.
Right. You had all these issues.
Yeah.
And that's with the Fed at zero and the economy sort of bumbling along. Now, change this. You come out of a once-in-a-century pandemic. Inflation spikes to 9%, $5 or $6 trillion in stimulus, and the Fed goes to 5%. What logic would there be? Assume there's some rationality for 2%, which, as you pointed out, there isn't. But let's assume there is. If 2% was the upside target in a slow economy at zero, Jesus, why 3% now when the economy is, hitting on all cylinders except for the areas where the Fed is constraining? Our biggest problem isn't the availability of credit. Our biggest problem is shortages in labor, in semiconductors, and in houses. Higher rates don't help any of that. And 2% target seems to be, when before the financial crisis did the Fed ever have a 2% target? That was a post-GFC target that should have been removed.
We were undershooting. People forget.
Right, we never hit. Right. Now we're on the other side.
The target was above our heads.
Right.
What about the argument that if they don't revert back to the 2% target and continue to talk about it, that they lose their credibility because of how long they did say 2% mattered?
The Fed.
The Fed does need credibility.
Yes, but I don't think so. I agree with you. The Fed needs credibility. I don't think the 2% versus 3% target affects their credibility, because they could say, we had a 2% target before you guys did $6 trillion in stimulus. Now we're going to have a 3% target. Let me also add, The Fed was late to get off their emergency footing in the entire 2010s. They were late to recognize in March 2021 when inflation shot through that 2% inflation target. They waited a full year to begin tightening, so they were late to that. They were late to recognize inflation had peaked and fallen, and now it looks like they're going to be late to recognize that they won, and any further tightening is going to put the economy at risk of making a soft landing more difficult.
This is your last point. You said mission accomplished. Jerome Powell can take the summer off, enjoy fishing at Jackson Hole, chill out for the rest of the year. No need for further increases in rates as the battle is already won. I started saying this in the spring when the banks were blowing up. And they've continued to hike rates, and they paused. Now it seems like they want to get off pause and hike again. But the data is overwhelmingly already directionally where they want it to be. So Michael and I are trying to figure this out. Why would you pause in June and then resume in July if you're data dependent and all of the data is telling you you're getting your way already? What's the unpause reason?
So the answer to that correlates with the stuck in the 70s, misunderstanding the modern economy. The only explanation that makes any sense is they're focused on the labor market, which is primarily driven by a shortage of low-wage workers who just don't have enough bodies. Too many people retired or out on disability, died during COVID, plus the past 10, 15
you're not
years
getting
has
them
been
back. Right.
Plus, you have had a giant decrease in immigration. As much as people want to blame Trump, that predates him by a decade, and Biden hasn't really changed legal immigration all that much. So we just don't have enough bodies. Somebody stuck in the 1970s, like Larry Summers, who says we need to throw 5 million people out of work to get inflation down. Well, we're at 3%, and you have the lowest. You have to go back to like 1953 to find an unemployment level the same as this. They're wed to I don't know how else to describe it other than a horrific misunderstanding of how the modern labor market is. And so they think we need more unemployment for inflation to go down, despite the past 18 months that have proven, no, you don't. You just need to get out of the way.
You just need more houses. That's pretty much it.
More houses,
Just
more
more
semiconductors
houses.
For cars, and more bodies. That's what you need.
All right, BR. What else you up to this week? Got a busy one?
Yeah, busy week. I'm in the office a couple of days this week, and I have a fun piece coming out that says how to get rich that I think you're going to love. It's one of those. It's one of those
read that.
Snarky, funny, and I say, here's the degree of difficulty. Here are the odds you'll be successful, and here's how long it takes. And it's pretty honest, and I think it's. You will not be surprised by my suggestions as to how to get rich.
No spoilers. That's Barry Ritholtz, everyone. My partner, founder of Ritholtz Wealth Management, and the host of Masters in Business on Bloomberg. Thanks so much for listening, guys. We'll talk to you soon.